It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, the employment picture. The employment situation in the U.S. has continued to be the bright spot in what otherwise appears to be a slowing U.S. economy. On the surface, the 261,000 jobs added in October looked strong and was well above consensus expectations for 200,000 jobs to be added. And at 3.7%, the unemployment rate remains low. Digging deeper into the non-farm payrolls report, however, you will see that the household survey, which is a sample survey of about 60,000 eligible households conducted by the U.S. Census Bureau, paints a different picture. Over the past 7 months, the non-farm payroll survey shows a net gain of 2.5 million jobs. The household survey, however, shows just 150,000 jobs have been added over the same period. If continuing claims are any indication, the employment picture could be souring as continuing claims for benefits have risen to their highest level since February, suggesting that Americans who are losing their jobs are having more trouble finding a new one in a labor market that's gradually cooling. Number 2, China's zero COVID policy. While most of the world has returned to some sort of normalcy since the COVID-driven lockdowns, China, the world's second largest economy, continues to enforce its strict zero COVID policy and is facing ever-growing pushback from its citizens. In recent weeks, demonstrators took to the streets in Beijing, Shanghai, and other cities in a show of defiance over President Xi Jinping's zero-tolerance approach to COVID-19. Despite vowing to slowly ease its strict rules on COVID, this is yet to happen. While not entirely caused by COVID and the associated lockdown policies, these have certainly impacted the country's economic growth, as it is now forecasted to grow at its slowest pace in nearly 3 decades. Consumer sentiment remains depressed, further exacerbating a severe property sector slowdown and the fallout from rising global inflation. The aforementioned protests will increase pressure on President Xi, and the comments since these uprisings provide hopeful signs that perhaps China is finally going to make changes to its anti-pandemic approach, which could provide some relief to the negative global economic impacts that have resulted. Number 3, yield curve flattens. For much of the year, you've heard us talk about tightening monetary policy and the resulting increase in interest rates. The question many were asking was how high rates might go. Following the Fed's most recent policy meeting, the governing body announced another 75 basis point hike, bringing the upper end of the Fed funds rate to 4%, its highest level since 2008. Short-term rates moved high to reflect Powell's guidance, however, long-term rates did not. With recent comments from Chairman Powell hinting at a slowing in the magnitude of rate hikes, the spread between the 2- and 10-year Treasury bond fell to its lowest level since 1981, leaving the yield curve deeply inverted. At the time of this recording, the yield on the 10-year Treasury was roughly 70 basis points off its recent high, while short-term rates remained elevated. What comes next for rates will certainly be impacted by inflation trends, and with inflation pressures likely to ease in 2023, long-term rates could follow suit. The yield curve is confirming a growing consensus view that the economy is in trouble and that the Fed could push us into a recession. And that's been your Market Minute for the month of December. Thanks for listening.